I'm talking to Gary Reynolds, Chief Investment Officer, about what he's doing with the team to make sure your investments are protected. Gary, hi. Lots going on in the world. Middle Eastern conflict, the most obvious. Can I ask, what time do markets open?
Well, markets are open most of the time, Leo. There's a sort of an hour where markets are shut. So generally at any time on certainly the weekdays you can trade the market. You know, UK opens as it closes, the North America is open, as that closes, Asia's open. So, you know, there's only about 10 o'clock at night when it stops for a little while, so you can generally track things.
So what were you looking at Sunday?
I was looking at the cricket. So I wasn't. I think that may sound complacent. I don't mean it to be so, but what you learn is not to burn loads of energy worrying about what you can't change. And I've said this time and time again, is that if you hit a crisis, if you're not prepared for it going in, there's not very much you can do about it as you hit it. And the other thing is, you know, I think I remember sort of going back to my Sunday school days, you were taught there's biblical version, there are wars and rumours of wars. There's always some conflict somewhere in the world. And you kind of, when you get to my age, you've been used to these flare-ups in the Middle East for forever, and they go back thousands of years.
So in that light, Gary, sorry, if that's the case, you're prepared for this in any eventuality. It's part of protecting clients' wealth.
It is part of protecting clients' wealth, because this is why we go on and on about diversification. Our actual job is not to try and shoot the lights out with the returns to get as many awards as we can collect, nice as they are. Our job is to help our clients see out the rest of their lives without a personal major financial crisis because they've got invested in the wrong things.
So what does this morning look like for you and the team?
Well, it looks all right, actually, because markets are going up. You check the oil price. What you've got to remember is where the media and the way things are structured today is there are loads and loads of, there's lots and lots of electronic media out there, and they all want to drag you in. It's a bit like walking down the high street, and the shop fronts are designed to get you into that shop, except today it's electronic. So news feeds throw information at you, and bad news tends to suck people in better than good news. So you get hit by a plethora of stuff on the possibilities of what could go wrong in the Middle East or with some conflict, and they'll all try and suck you in. But what the markets reflect generally is what people are actually doing with their money. First thing this morning, markets were sort of bouncing back a little bit, and then putting this oil price issue into perspective. We all think, people of my age all think to the 1970s, the oil embargo, the very, very high oil prices, which led to rampant inflation. In fact, led to stagflation, very, very high inflation, and no GDP growth. A terrible situation. But the world's different today. Oil supplies are more diversified. The US is a net exporter of energy, not a net importer. So it's a different place. And to put that into context, I think, you know, the oil price peaked at around $137, $138 a barrel Brent during the Russian-Ukraine crisis. And prices have gone up to about $78 now, which is exactly where they were just before that Russian-Ukraine crisis started. So it shows that overall there's a downward pressure on oil prices because other energy forms are coming to the fore. I mean, somewhere like Switzerland is hardly reliant on oil at all. It's nuclear, it's hydro, and lots of other places around the world are going down that route.
Well, this leads me to think what I was thinking anyway. The spotlight's on US, Iran, clearly, at the moment, Israel. But globally, that's your focus day in, day out. So the macroeconomics, what are you and the team looking at? Remind us, what countries are under your spotlights at the moment?
Well, probably the main thing that's under the spotlights at the moment, which we sort of alluded to in an article that went out recently, is the normalisation of interest rates. Because this is a big change. For me, somebody like me, it's a theme of extraordinary interest. Because what did Napoleon say? Show me the individual in their 50s and I'll tell you what the world was like with their 20s, or worse to that effect. we tend to have our views on the world and global tensions and macroeconomics formed in our late teens, 20s, when we are very influenced. So I cut my teeth in the 70s with high inflation and very, very high interest rates. So for me, that was normal. What seemed abnormal to me was very low interest rates. For a lot of the youngsters, people that came into working in the financial sector after the global financial crisis, which is sort of 2008-9, have been working in this sector for 16, 17 years now, have come from uni, have probably now in their late 30s, early 40s, have risen up to quite positions of importance. And for them, very low interest rates are the norm. For me, very high interest rates were the norm. So I've gone through that period. Now I'm looking at the very low interest rates. And by the way, the low interest rates of the noughties were the lowest on record. So you won't find anything as low as that, not even reading the history of, Homer's fantastic word, the history of interest rates, or the Bank of England's 800 years of financial history in the UK, which they publish. You won't find them as low as that. So we've got, and likewise, you wouldn't really find anything as high as they were in the 70s. So in my lifetime, I've seen the absolute peaks and the absolute troughs of interest rates. Well, this is what's going towards now, is a more normalisation. That's actually quite good for investors, because you can get a reasonable rate of return on your bank or building society deposit. You can park your safe assets somewhere safe and not think that inflation's ripping the living daylights out of their purchasing power. And that, I think, is much the bigger theme going forward. Now, please take this in context of what I'm about to say now. That's arguably a lot more important than what's happening in the Middle East, notwithstanding that wars create horrendous consequences for families and people. So I don't want to sound heartless, but in terms of our job, I think more about interest rates than I do. I think the oil prices are rising from what's going on in the Middle East.
So what does this normalisation of higher interest rates mean?
Well, it means for the average investor you can get a decent rate of return on your cash ISA or your building society or bank deposit. There's a lot of speculation as to saying, oh, yes, but it also means the cost of servicing debt for the government, because debt's very high, is a problem. Yes, that's true to an extent, but it's offset by the fact that extra interest payments go into the economy, so people have more money going into their pockets in the form of the return of the capital they're keeping around. So you're just getting back to a more normal environment. But if you look at the cause and effect, and if I just dial back a little bit, when you think that it's not too long ago, in the summer of 2020, in the teeth of the COVID crisis, that 10-year interest rates in the UK, as measured by 10-year gilts, are virtually zero, almost unheard of. So what you can say is interest rates are just a price, and they're the price for access to money. Now, if you've got lots and lots of money looking for a home, the price, the interest rate, is going to drop. And if you've got lots and lots of people looking for money, the price will go up. So a price of near zero tells you that there are piles and piles of savings that people are trying to, get out there. So they're offering it at very, very low rates. But it also tells you there's probably not a lot that people want to borrow the money for. So although we've seen a rise in government borrowing, post-global financial crisis, we saw a massive repayment of borrowing from the private and the corporate sectors. So we're going back to an environment now where perhaps people will start to think of borrowing again to get back onto the housing market, and hopefully companies start to think about borrowing to get projects done again. So two things, it's cause and effect, and it's what does that price of money mean. But overall, you're going back to a more normal situation, whereas some of the media comment is saying, 10-year gilt yields at 4.5%, the country can't afford it. Of course they can afford it. They were saying that before we came out of the COVID crisis, that the country could never afford higher interest rates again. Well, that's been proved completely wrong, particularly in the States. So I think it's a really, really good thing. And from our perspective, it means we can keep risk controls for clients in a good place and earn some extra money on that part of the portfolios where we're trying to counterbalance the bits we take more risk with.
And recently, touching on a recent piece about introducing long-dated gilts into the investment grade bond fund, what does that actually mean for investors?
Well, what was very unusual in 2022 is that we were very anti long-dated gilts, which put us in a great place when that notorious budget from Truss and Kwarteng came out in the autumn of that year, and gilt prices dropped like a stone. Holders of long-dated gilts lost up to 40%, which is really bad news for a supposedly safe asset. It was great news for us because our relative returns in 2022, even though it wasn't a great year, because asset returns were at best flat, at worst negative in that year, we scooped up a load of awards in the early part of 2023. And that was because we were not holding long-dated bonds. And that's probably going back to what I was saying earlier. My period, cutting my teeth in the 70s, has always made me very wary of bonds, because as interest rates go up, they come tumbling down. So we were in a good place. But it was an unusual place, because generally you would expect a portfolio to have some exposure to long-dated bonds. Well, as this normalisation is coming through, we are able to buy more long-dated bonds, and that means if we're holding 10-year gilts today, we can get a return of about 4.5%, which inflation, even with inflation slightly raised just over 3, is giving a positive return to the investor, and we can maintain purchasing power. So for us, we can kind of breathe a sigh of relief and think, phew, this is better, because it enables us to balance the portfolios a lot more than we could when interest rates were at zero. You can imagine, everybody's piling to gilts. Everybody's worried about equities because of the pandemic, spooked on equities, got it completely the wrong way round. The thing you should have been worried about was more gilts and not equities. But it's very difficult. If you're not going to buy these long-dated gilts, what else are you going to buy to try and offset the risks? You go to cash, which is generally what we ended up doing, but you're earning nothing. So you've got a chunk of asset which is trying to keep risk down, but isn't doing very much. Now it's more normal. So this is a much better time to be managing money than in 2022.
So lots of focus on UK interest rates. It must be interesting scouring the whole world for companies that might be worthwhile to invest in.
Oh,
I
yeah.
always like to ask, are there any exciting stocks that you're looking at globally at the moment?
Well, there are lots of exciting stocks we're looking at. There are companies in Japan, there's companies in South Korea, there's still companies in the US. I know I don't like the Mag 7, but it's not that I don't think they're great businesses, I just think they're overpriced. But perhaps if I just sort of say one asset class that is really interesting to look at is infrastructure, because right now you can get a cracking yield of around 7 or 8%. That's a lot more you're going to get on 10-year gilts. But unlike gilts, some of the infrastructure income flows are index linked, so you can increase your yield as well as getting a fairly stable income. Now they've had a really bad time because with everybody seemed to have ignored their inflation protecting capabilities. But we need infrastructure in the UK. There's lots of hydro and sort of solar, wind, all sorts of facilities that we need to put in place. But the really exciting thing with that, it seems to be underpriced. And recently, an asset we'd held for a long time, BBGI, which had a range of sort of global infrastructure products, suddenly got bid for by a Canadian pension fund, and we saw sort of a 20-30% uplift on the price very quickly. Now, I was sad to lose that asset because I had immense respect for the guys that ran it, but it does show there's some potential there. So we get excited about that because we get the low risk credentials we want, particularly for cautious investors, to try and dampen risk, but we still have a lot of potential upside. So we find that very, very exciting.
Gary, thank you for your time and for your insight as always. We'll continue to look at the markets day in, day out, And if you do have any questions at any time, please speak to your advisor or contact us. Thank you.